Part 3 of this video. So, General Electric, of course, has been a household name for generations. Like light bulbs, electric fans, refrigerators, other appliances in millions of American homes. But today, the consumer appliance division of that company is basically amounts to 6% of its actual operations and revenue, while lending accounts more than 30%. In other words, GE has become an unregulated lender and basically involved in financial business, not manufacturing so much. And I'd like to add as a personal note, in case you didn't know this, GE owns a lending division called Care Credit. Care Credit is a consumer. It's a company that basically extends loans for medical expenses, no less. Now, if you have to go to your dentist and can't pay your bill, or if you have to pay your veterinarian or for some eye surgery, which is not covered by your insurance in any way, then you will be referred most likely to Care Credit, which is part of this huge lending business for GE. And because its lending division, GE Capital, has provided more than half of the company's profit in some recent years, many Wall Street analysts view GE not as a manufacturer, but as an unregulated lender that also makes dishwashers and MRI machines and jet turbines and nuclear reactors. You see where this is all headed. So, as it has evolved, the company has used, in some cases pioneered, aggressive strategies to lower its tax bill. In the mid-1980s, Ronald Reagan overhauled the tax system after learning that GE, a company for which he was a peddler, as an actor before that, was amongst dozens of corporations that had used accounting gamesmanship to avoid paying any taxes. I didn't realize things had gotten so far out of line, Mr. Reagan told the Treasury Secretary, according to Mr. Reagan's 1988 memoir. The president supported a change that closed the loopholes and required GE to pay a far higher effective tax rate, up to 32.5%. That pendulum began to swing back in the late 1990s. GE and other financial service firms won a change in tax law that would allow multinationals to avoid taxes on some kinds of banking and insurance income. The change meant that if GE financed the sale of a jet engine or a generator in Iceland, let's say, or the company would no longer have to pay American taxes on the interest income that they were actually getting. Known as active financing, the tax break proved very beneficial to investment banks, brokerage firms, auto and farm equipment companies, and lenders like GE Capital. This tax break allowed GE to avoid taxes on lending income from abroad and permitted the company to amass tax credits and depreciation. Those benefits are then used to offset taxes on its American manufacturing profits. And GE has subsequently ramped up its lending business. Ready for more?